Your financial advisor probably likes you. They remember your kids' names. They send a card at the holidays. They call to check in when the market drops. They make you feel like someone is watching out for you. That is not the problem. The problem is not the person sitting across from you. The problem is the system they operate inside. A system that was not designed to make you wealthy. It was designed to keep you as a client. And those two goals, your financial freedom and their business model, are not the same destination. In fact, in many cases, they point in completely opposite directions. So here is the question this video is going to answer. Why doesn't your financial advisor want you to be rich? Not because they wish you harm, because the way they get paid, the structure of the entire industry, means your financial independence is, quite literally, bad for their business. Stay with this one, because the third thing they never tell you, the one about what happens to their income when you no longer need them, is the one that makes everything else make sense. 4 things your financial advisor has never told you. And the reason each one was never mentioned is hiding in plain sight. The first thing they never told you. Most financial advisors are not legally required to act in your interest. Read that again. Most financial advisors are not legally required to act in your interest. You probably assumed they were. Most people do. The title sounds authoritative. The office looks professional. The certifications on the wall look official. The relationship feels like trust. But the legal standard most advisors operate under is not called the fiduciary standard. It is called the suitability standard. And the difference between those two words is the difference between someone who must act in your best interest and someone who only needs to recommend something that is suitable for your situation. Here is what that actually means. Under the fiduciary standard, the higher standard, an advisor must recommend what is best for you, period, full stop. Their interests come second. Under the suitability standard, the lower standard, an advisor must recommend something that is appropriate for someone in your general situation. Not the best option available, not the lowest cost option, not the option most aligned with your long-term wealth. Just an option that is suitable. The distinction sounds technical. The financial consequences are anything but. A commission-based advisor operating under the suitability standard can legally recommend a mutual fund with a 1% annual expense ratio when a nearly identical fund with a 0.05% expense ratio exists. Both are suitable. One makes the advisor significantly more money. One makes you significantly more money. Under the suitability standard, legally, technically, without any wrongdoing, the advisor can choose the one that benefits them, and you would never know. Because the fee is not billed to you directly. It is buried inside the product, on a statement you probably do not read, in a line item you were never taught to look for. Now stop and ask yourself a question you may have never thought to ask. Do you know which standard your current advisor operates under? Not which title they hold, not which firm they work for. Which legal standard governs the advice they give you? Fiduciary, legally bound to your best interest, or suitability, legally bound to something that is merely appropriate. If you do not know the answer, you do not know whose side your advisor is on. And that is not a small thing. That is the foundation everything else is built on. Because an advisor operating under the suitability standard is not doing anything illegal when they recommend the product that benefits them over the one that benefits you. They are doing exactly what the system was designed to allow. There are advisors who operate under the fiduciary standard, fee-only registered investment advisors, RIAs, who are legally and ethically bound to put your interests first, always. They exist. They are the right standard to look for, but they are not the majority. Only 4.92% of all financial professionals are true fee-only fiduciaries. The other 95% operate under a standard that was not built for you. The first thing, your advisor's legal obligation to you depends entirely on how they are registered. Most people never ask. Most advisors never volunteer it. The second thing they never told you, the way they get paid means they earn more when you buy, not when you grow. Here is how most of the financial services industry actually works. An advisor recommends a product. You purchase it. The product company pays the advisor a commission. Not you, the product company. Which means the advisor's income is not tied to whether the product performs well for you. It is tied to whether you buy it. Think about what that incentive structure produces. An advisor who earns a commission on products sold has a financial incentive every single time they sit across from you to recommend a product. Not to tell you to wait. Not to tell you the low-cost index fund you could buy yourself in 15 minutes is the better option. Not to tell you that your current portfolio is actually fine and needs no changes. To recommend something. Because recommending something is how the invoice gets paid. Here is what that looks like in real numbers. The average commission on a variable annuity sale, one of the most commonly recommended products in commission-based advisory relationships, runs between 5% and 8% of the investment amount up front. On a $100,000 investment, that is $5,000 to $8,000 paid to the advisor at the moment of sale. Regardless of whether the annuity performs. Regardless of whether it was the best option for your situation. Regardless of whether a simpler, lower-cost alternative would have served you better. The commission is paid at purchase. Your outcome is determined over decades. Those two timelines are not aligned. Now ask yourself this. The last financial product your advisor recommended, do you know how they were compensated for that recommendation? Not roughly, specifically. Did they earn a commission? What percentage? Paid by whom? Or were they paid directly by you on a flat fee or hourly basis with no financial stake in which product you chose? If you cannot answer that question, you do not know whether the advice you received was designed for your portfolio or for their income. And here is the part that makes people genuinely uncomfortable. Most people never ask. Not because they are careless, because the relationship feels like trust. Because the office feels professional. Because nobody sits down across from someone who seems to care about them and says, "What are you making on this recommendation?" But that question, asked directly, without apology, is the single most important question you can ask any financial professional. How are you compensated for this recommendation? Not how are you compensated generally, for this recommendation, specifically. The answer tells you everything about whose interests the advice was designed to serve. A good doctor gets paid the same whether they prescribe you a name brand drug or a generic that costs a tenth of the price. A commission-based financial advisor does not. The incentive to recommend the more expensive product is built into every conversation, every meeting, every recommendation. Not because your advisor is dishonest, because the system was designed that way. The second thing, commission-based advice is not free advice. You pay for it through the products you buy, over the decades you hold them, in the returns you never see. The third thing they never told you. Their business model profits from you staying dependent, not from you becoming free. This is the one that makes the whole picture clear. The most common fee structure in the financial advisory industry is called AUM, Assets Under Management. Your advisor charges a percentage of the total portfolio they manage on your behalf. The industry average is approximately 1% annually. On a $500,000 portfolio, that is $5,000 a year. On a $1 million portfolio, that is $10,000 a year. Every year. Whether the market goes up or down. Whether the advice is exceptional or ordinary. Now here is the question nobody asks. What happens to your advisor's income when you become financially free? When you no longer need someone to manage your money? When you understand your portfolio well enough to manage it yourself? When you reach the point where a simple, low-cost index fund strategy, one you could implement in an afternoon, serves your needs better than an actively managed relationship? Your financial freedom is their revenue loss. Not because they are malicious, because it is mathematics. An advisor whose income depends on you keeping assets under their management has a structural incentive, however unconscious, to keep you dependent, to keep the relationship feeling necessary, to keep the complexity high enough that leaving feels risky, to keep you believing that what they do requires expertise you could never develop yourself. Here is what that looks like in practice. Have you ever had an advisor proactively simplify your portfolio? Reduce the number of funds you hold? Suggest you move to a lower-cost structure that you could manage yourself? Tell you that at your stage of wealth, you might not actually need them anymore? Think about that honestly. Because an advisor whose compensation is tied to the complexity and size of your portfolio has no financial incentive to simplify it. Every additional fund, every additional product, every additional layer of management keeps the relationship feeling indispensable. And an indispensable relationship is a retained client. And a retained client is recurring revenue. Now look at the lifetime math. 1% annually does not sound like much. But on a $500,000 portfolio held for 20 years with average market returns of 7% annually, the difference between paying 1% in advisory fees and paying 0.05% in a low-cost index fund is not $5,000. It is approximately $300,000 in lost compounding. $300,000. Not taken from you in a single transaction you could see and evaluate. Quietly subtracted from your returns, every quarter, for 20 years, while the relationship felt like care. That number is not a criticism of any individual advisor. It is an indictment of a fee structure that charges a percentage of your wealth every year indefinitely for a service that, for most mid-career investors with a clear financial plan, does not require that level of ongoing cost. Ask yourself right now, what is the total dollar amount you have paid in advisory fees over the lifetime of your current relationship? Not the percentage, the dollar amount. Add it up, then ask, what did I receive in return for that specific number? Not peace of mind, not the feeling of being taken care of. Measurable, specific financial outcomes that justify that specific cost. Most people have never done that calculation. Most advisors are counting on it. The third thing. An advisor whose income depends on managing your assets has no financial incentive to help you need them less. Independence is your goal. Dependency is their business model. The fourth thing they never told you. There is a better standard, and you can demand it. This is where the script changes direction, because this is not an argument against getting financial help. It is an argument for getting the right kind of financial help, from professionals whose compensation is structured to align with your interests, not to compete with them. It starts with one word: fiduciary. A fiduciary advisor is legally required, not encouraged, not ethically guided, legally required to act in your best interest at all times. They cannot earn commissions on products they recommend. They cannot benefit from recommending one fund over another. They must disclose every conflict of interest. They must recommend what is best for you, not what is suitable, not what is profitable for them. Here is what to look for specifically. A fee-only fiduciary registered investment advisor, RIA, is the cleanest structure available to most investors. They are paid directly by you, flat fee, hourly rate, or a transparent AUM percentage that you negotiate and understand. Nothing from product companies, no commissions, no kickbacks, no buried incentives. Their success is defined by your outcomes, not by how many products they sell or how long they can keep you dependent. And here are the 3 questions asked directly at the first meeting before you sign anything that separate the advisors worth trusting from the ones worth walking away from. 1. Are you a fiduciary at all times for all recommendations? Not sometimes, not for most decisions, at all times. 2. How are you compensated specifically for the recommendations you make to me? Not generally, for each specific recommendation. 3. What happens to your income if I simplify my portfolio, reduce my assets under management, or decide I no longer need ongoing advice? An advisor who cannot answer all 3 questions clearly, immediately, and without defensiveness is an advisor whose compensation structure cannot withstand daylight. An advisor who answers all 3 confidently with full transparency is an advisor worth talking to. Now here is the identity shift this video is asking you to make. Stop thinking of yourself as a client. A client is someone who defers, who trusts the professional across the table to know best, who does not ask uncomfortable questions because the relationship feels important. Start thinking of yourself as the employer, because that is what you are. You are hiring someone to work on your financial future. You set the terms. You ask the questions. You evaluate the performance. You decide whether the relationship continues. Your advisor, the right advisor, will not just tolerate that posture. They will respect it. Because an advisor who operates under a genuine fiduciary standard has nothing to hide from an informed, demanding client. Their compensation is transparent. Their incentives are aligned. Their income grows when yours does. That is the relationship that builds wealth, not the one that feels comfortable, not the one where someone remembers your kids' names and sends a card at the holidays. The one where every recommendation, every fee, every decision is structured to serve one person's financial future, yours. If this video made you want to question every financial relationship you are currently in, every video on this channel starts with why. Why your salary is keeping you poor. Why your retirement plan is a fantasy. Why smart people stay broke. Every rule you are handed about money, questioned. Remember this, your advisor's job is to manage your money. Your job is to manage your advisor. Start acting like it.